Good morning, everybody. Welcome to the Flow Show, Tuesday, 26th of March. Nearly approaching month end, quarter end. Forgot to mention that yesterday. Got all that palaver coming up as well, so things could get slightly choppy around the fixes. Need to keep an eye on that as well this week. Right, let's get straight into things. Over at the PBOC, we've had the head man there speaking. Says China has ample policy room for the economy. Potential hint at further rate cuts to come, RRR cuts, and some of the other rates they've got going on. Keep touting it. They're keeping that in that toolbox well and truly open. Says there are positive signals in the property market, if that's to be believed. Other areas suggest that there's still big problems over there in that part. Over in Japan, Economic Minister Saito said gasoline price measures will not continue indefinitely. These are the government support measures that they've got in place suppressing gasoline prices. That isn't going to last forever. I think off the top of my head, it's either finishing the end of or slated to finish the end of the fiscal year or June. I can't remember which one. But once that drops off, that may be a bit of inflationary pressure that comes in as those prices go back up. Finance Minister Suzuki says it's important for currencies to move in a stable manner, reflecting fundamentals, and then he listed off all the other usual lines on that. No step up in rhetoric. They're still at sort of DEFCON 1 or 2, if you like, not really getting it too high. Comments all stand the same. It's when they start saying that moves now are too volatile or too speculative, that's when we get closer to intervention. The head of the business lobby, Kinderman, says that the dollar-yen rate beyond 150 is excessive. So not liking things up here, putting a bit of pressure on firms and the like, but it's always a double-edged sword between importers and exporters, which way the currency goes as to which side it favours. There's always two sides of a story in that argument, but that might be something the government and the BOJ keep an eye on. Over in the UK, and Kantar grocery inflation numbers for the month ending March 17th showed grocery prices dropping below pre-Ukraine war levels. Inflation there at 4.5% versus 5.3% in the February month. So a little bit more relief coming in for us UK shoppers, though that's still price gains. We're not seeing yet any real disinflationary numbers coming in where we get negative grocery level prices, i.e. dropping. Bank of England's man was out again explaining in more detail why she moved to the sidelines from a hike in her vote. Says it was time to move from a rate hike and that changing dynamics in the labour market helped make the decision. Also that the market curve also helped in her decision making. So discretionary services prices have softened for the consumer, saying that they're not, long story short, they're not looking at spending on big ticket items. That discretionary spending, it seems to be softening. Also says that the consumer discipline on prices helped vote for a hold. Also, the labour market is tightening and that firms are hiring less. Which did say that in February, markets were betting on too many cuts. Also says that markets are perhaps a bit too complacent about how long the BOE will hold rates. It says in some ways the BOE does not have to cut because the market already is, pointing to those loosening financial conditions that a lot of central banks talk about when the market does the central bank's job for them. Says it's hard to argue the BOE would be ahead of the ECB and the Fed. I make her right on that. A few people picking up June forecasts for the BOE cut, as I mentioned yesterday with HSBC, one of those. I don't think June is a real prospect personally. I think it will likely be later unless there's a real continuation in the fall in inflation. If we get to maybe May and inflation is down, with a 2 handle, 2.7, 2.5, 2.5, something like that, then maybe they will think about a June cut. But if it's not, then I think August might be the earliest. But, we're all data dependent, as much as they are. Over at the ECB, Panetta says there is a growing consensus within the ECB Governing Council that there'll be a possible rate cut. Bit of a no shit Sherlock comment there. The ECB's Lane is confident that wage growth is slowing as expected. Wages obviously being the big item, one of the big items for the ECB in their deliberations. ECB's Muller says that data may confirm in the inflation trend for the ECB's June meeting. Looking at a bit of the data that we got yesterday, we got some regional, one of the regional manufacturing numbers from the Richmond. That was from the Dallas. That was a bit soft, coming in at minus 14.4, so no improvement over the minus 11.3 last month. New home sales. Slight miss. It was in and around last month's numbers, so no big deal there. Slight miss on last month, slight miss on what was expected. In the selling prices, though, the medium sale price was 400,000, just over 400,000, which was down 7.6% from February last year. So quite a steep drop on the year. We've seen other medium house prices coming in a little bit better, but these are new home sales, so maybe there's a bit of pressure coming in from home builders having to get people into properties. Might be some cuts coming there in prices. Something just to keep an eye on. Again, it alludes to the consumer, whether they've got the appetite to borrow money at these higher rates and affordability and that sort of thing. So again, one swallow doth not make a summer, but if we start to see a trend in house prices downwards, that will be another brick in the wall of mine looking for a potentially weaker consumer out the US. On the Fed front, Fed's Bostic says he expects the economy and inflation to slow gradually. If the economy performs as expected, the Fed can be patient. Now he's moved his dot. He only expects one rate cut this year. He first touted that on Friday, but back before this FOMC meeting, he was in the 2-cut camp, and now he's only in a 1-cut camp, so a little bit more on the hawkish side. He was one of the earlier and biggest proponents of the Fed going on pause, which was seen as a bit of a dovish tilt last year, but now he's sounding a bit more hawkish about only 1 cut. Fed's Goolsbee says we're in a bit of a murky period with inflation. It doesn't feel like the story has fundamentally changed. 3 cuts in 2024 was in line with his thinking. Fed's Cook says the risks to achieving employment and inflation goals are moving into better balance, quoting a line from the boss. The risks to easing policy too much or too soon are the same, as well as doing so too late. Wage growth differential between job switchers and those staying in jobs has narrowed. Now, that's something that you can see in the JOLTS report. There's a component called the quits number, and that's a good indication of people who are changing up jobs. So people who are in jobs decide to leave voluntarily, in likeliness because they've got a better, higher paying job. And she's saying that the wage differential between the job switchers and those staying in jobs has narrowed. So there's less inclination for people to change up jobs, which is also a sign for potentially slowing jobs market, because those higher wages are now, according to her, not as great. So less need to move for less bucks or more bucks. She's unsure if the neutral rate is higher or not, and will likely only know after the fact. I think that's a fair point. They're not going to know where they want to settle until they've got there and everything's settled down in terms of the economy. Over on the oil front, OPEC plus delegates see no need to propose any policy changes next week. which has got my tinfoil cap on, because the last few times they've touted that they're going to do something, they've had a market reaction, and it's been a big old buy rumour, sell fact. So there's a little part of me that's saying perhaps they're saying nothing, and then they'll go and announce something just to get a bigger bang for their buck, because it will be a surprise. I doubt it, but as I say, that's my little conspiracy theory for that. The Russian government tells oil companies in the meanwhile to cut output to 9 million barrels per day by the end of June to hit their OPEC plus targets. Russia obviously still doing what it wants to do regarding oil and energy, and where they sell it to, and all these sanctions going in that they've been circumventing from day one. So we'll see how that pans out. Not a lot of news. It was a very quiet day yesterday. So look at that, 11 minutes in, and we're already done with the headlines. Obviously, Kay's still off for the next couple of days, so I can't bat it over to him. So just me and my thoughts on this one. So we'll get into looking at what we've got coming up. Not a lot on the books today, but a couple of big items from the US. There was nothing much in Europe today. Final Spanish GDP numbers there, nothing to write home about. But we do have durable goods, and we also have the Conference Board consumer confidence numbers, which for me are going to be pretty big to watch. Now, durable goods are a very volatile number at the best of times. Okay, so you can see durable goods expected up 1.2 from down 6.1 last time. So you can get big swings in here. Now, what I'll be looking at in this data is some of the underlying components that make up this report. There's obviously a lot of big ticket stuff in, aircraft, defence, transport, that sort of thing. But underneath that, you get things like appliances, household goods, computers, electronic equipment, it counts as TVs and that sort of thing. And those will be the numbers that I'm going to be focusing on, just to see how potentially the US consumer is doing. If businesses aren't buying goods to sell in stores, that is an indication of potential weakness. Then we got the consumer confidence data, which does what it says on the tin. It's a measure of consumer confidence. It was quite a significant fall from the last reading. It was 114.8, and we moved down to 106.7. So that was quite a big dip. Similar to what we've seen in the Michigan numbers as well. Both these metrics had a decent run into the end of the year, which could be holiday period related, and it's done nothing but fall since then. So it might just be we're washing out some of that year-end stuff, or it could be that we're starting to see a trend in the consumer just feeling a little bit less well off, shall we say. So these numbers are going to be important today, again, for my view and my magnifying glass over the consumer. Inflation expectations will be a big part of this as well. They were last in the 1 year at 5.2%, which was unchanged over the prior month. So it's still running pretty hot. The Fed will want to see that coming down as well, but that could influence things. Still got a pretty quiet market, quiet-ish market this morning. So this data, both the durables and the other, might have something to say about prices and some moves that we get today. And we've also got some house price data as well, house price index data for January. Obviously, that data I spoke about just a moment ago, new home sales, that was February data. So this is house price data for January from Case Shiller and the FHFA, just something to keep half an eye on. And a little later on, we get another regional manufacturing number, the Richmond Fed. So again, not potentially market moving, but that poor number yesterday, the Philly Fed wasn't exactly all guns blazing. So just see if some of these other regional ones are pointing to potentially deeper problems for manufacturing. I think, if I'm not mistaken, we'll start to get the ISMs next week alongside the final PMIs. Obviously, last week we got the flash PMIs. Next week we should get the final numbers coming in from those. Right, what's been going on? Gold. I was going to look at that, Derej. I don't know what's caused the spike. I've seen, I could have missed them. I was doing the trade-off recording this morning, so I could have missed some headlines. I've not seen anything behind this spike in gold. I don't know if perhaps it's something still going on with this Israeli stuff, these talks that are ongoing. They seem to be popping up every headline or every other headline about these talks of ceasefires and hostage exchanges. The Houthis as well were making a big statement, or going to be making a big statement in an hour or so. So I don't know if it's just a bit of a risk move, but I haven't seen any headlines. Feel free to throw something up if someone's seen something I haven't. We can look at that. And just saying, I don't know if you mean the dollar in reference to gold. The dollar's not moved an awful lot. Not to initiate a sort of 25, 30 buck move in, well, less than that, 20 buck move in gold. As I say, it does look maybe a bit of a risk play. But then we look around the other grounds, yields aren't doing an awful lot. And yeah, it could exactly be that rebalancing, Angela. It could just be some month-end stuff. Not that we tend to see moves in things like gold, but we have seen things happening in oil around end of months, and it is end of the first quarter. So it can be a fairly busy one as well. Obviously, this week is also the end of the financial year in a lot of places. So that's why this end of month can be a bit spicy, shall we say, the end of the first quarter. But yeah, but really, I have no idea what's going on in gold. Sorry, Derej. Well, let's go back to it and have a look at the chart. So we know where support is roughly around this 21.40, 45.50 area at the moment, and all eyes back on these highs, and more importantly, these highs around 22.10. That's where the resistance came in after that spike move. So this is probably more your realistic or real high that you need to pay attention to. So if it gets up there and starts holding, if you are looking for the short side, that's the level you want to sort of lean on, and you know you're wrong if we then go on to take out that high. Conversely, this 21.45, 47, whatever you want to call it, support line is the problem side on the downside, but then we have some other minor levels ticking down on the way there too. But yeah, it's whenever you see moves in gold, in something like gold, you just need to have a look around and see what else is moving. You know, if there's other risk assets moving, then maybe it's part of a wider move. Gold looks like it's standing out on its own. Let's have a quick look at silver. That's had a little spike it up, but not too much, not in the same sort of volume as gold is doing. So yeah, maybe gold standing out on its own for some reason. But yeah, looking at yields, we had a bit of a bounce off this 420. I said yesterday it looked a bit dead cattish. Still looking dead cattish at the moment, and that's why we're seeing the dollar weakening a little bit. I think it's going to need a break of this level to get things really moving. This 420, this is going to be my sort of decision line, if you get my drift, particularly for the dollar. We've seen the creep up in euro dollar continuing. It's moved into the zone. The zone's trying to become support at the bottom at this 108.30. Banging ahead around this old fib level. It has been a little bit of an area, but nothing that I'll trade or anything like that. 108.70 is the main zone here. We need to get back above that level, but it's on the grind. We're doing, you know, however many 10, 20 pips in hours. So it's not going big guns at the moment. It's just markets are drifting around. That's all I can say at the moment. So, you know, as much as strong as this looks, I would have liked to have traded it, but I didn't. But as strong as this looks, in the wider context, we're just ranging and moving around in some of the intermediate levels at the moment. If you were long off this 108 level, well done. You know where you want to be slicing and dicing and looking to get your stops up behind it, and where the top side levels are going to come into play. As I say, 108.70 is your immediate level here. After that, we're looking at 109s, and then obviously up towards these prior highs here, if we get that far. It's a pretty similar picture all the way around. Aussie dollar, very similar as well, trying to creep up, trying to get above this 65.40 area. But as we've seen from this move here, sellers are happy to spank it when needs arise. So it all feels a bit touchy-feely. You know, it doesn't look like buyers are really committed to getting it up here, but it could just be the conditions, and we find out that we're going to grind up 20 pips a day, and then all of a sudden you come in on Thursday and then we're trading 66s again. Yeah, it's just the way markets are at the moment. Euro sterling, again, gives you an idea that it's a dollar move, because cable and euro dollar largely moving in the same sort of speed, so there's no real change in this one. If something was really going, if the dollar was really getting sold off, obviously cable will be moving a bit faster than the euro dollar, and then we'll be seeing this one pulling back a little bit more. We're mooching around this 85.70 level, which, as we all know, was the resistance for the last few weeks, around that 70.80 area. We're trying to hold it. It's not definitive. We're trying to hold it, but I see no reason fundamentally why this should move significantly in direction. So it's still down to the speed, pretty much, as I said, of cable versus euro dollar. But for me, it's holding up nice enough. But if we don't get another test up towards 86, I'm probably going to cut a bit more of the longs I put on the other day, and just take some more, stick some more in the bank, just keep the core position, and just manage it from there. 86, 10, 20, the level we need to get above on that one. Ratio, yeah, that's what I mean. It's not, it's like the dollar's going at different speeds everywhere. You know, dollar yen isn't doing an awful lot. It's not weakening like we're seeing elsewhere. It's staying up here. It's proving a bit sticky, and that's something we need to be aware of. One, because it can lull you into a false sense of security, but on the other side, it tells you that the market doesn't really know what to do with it up here. Does it want to have a crack at that 152 with the intervention risk? But it doesn't want to sell it either. So yeah, I'm still a bit sitting on my hands with this one. I don't know which way it goes from here, and if that's my viewpoint, I'm less inclined to play a trade on it. But if I start seeing some of these weaker numbers out the US, if we start seeing some of these consumer numbers coming in a bit softer today, I might think about getting in shorts. But whether I play it here or somewhere else, that's another decision to be made. Obviously, you're still costing money if you're shorting this one with a carry. So I might concentrate on something like cable or euro dollar, maybe even Aussie dollar, if I want to play some US dollar weakness on that side of things. We'll have a quick look at the Swisses. Dollar Swiss still banging up near that high, but it's holding for the moment. So get another test up here, a couple more tests up here, and then we start to think that perhaps there's something more solid up there. At the moment, it's looking like, on balance, it probably looks like a break is more likely than a drop from here. You know, maybe a 60-40 favour of a break, just because we're looking like we're just building in that move there. We had a sharp move off the highs, and now it's, you know, the dip didn't get too far, and now it's just building again. But at the moment, there's enough up here to keep it from breaking higher. But if we break higher, from this point, then you're probably going to see this become support. So if you're long, you want this level to break. If you're short, you don't want this level to break. If you're not in nothing at all, you can use this level as a potential place to get into a break with perhaps a long, if either on the first break or if you see a retest and hold. That will give you some confidence to get in now. Dollar China, that's still mooching around. It hasn't really moved back either way. It's had its little move. It's had its little smack on the head by state banks, and now it's doesn't know what to do. So the fact we're still up here and haven't come down back to closer to 720s suggests the market's not quite ready to give up on selling the yuan, but maybe it's just a bit more fearful of getting that mallet round the chops again from those state banks. So yeah, a bit undecided here. It might be that we're just going to move into a bit of a different range where we had this sort of price action, sort of 16s, 20s. We might get similar up here, maybe sort of 21s to 28, something like that. It might just step up a bit. But we'll see what happens with those PBOC officials and what they want to do with it. On the vol front, it's not looking too hot either. Dollar yen vols 7.13%, so that's coming down a bit. It was back up near the 8s over last week. Naturally, we're seeing some of that vol coming off again. Euro dollar, it had a little look under the 5% mark in the 1 month vols, which is currently trading 5.01%. Below 5%, we're getting into real quiet territory. That's when we're, like we've just seen, it's taken nearly 2 days for it to move, 42, 52 pips. That's not good for us, but it means we then get these vol injections. So if we get a big data point, a big speaker, a big headline, you're going to get a bit of vol suddenly coming in. Cable as well, now below 6%, trading at 5.8%. So these vols are coming down. But just to repeat how you use these vols, and while we're talking about it, I'll see if I can get it. I'll see if I can get the vol chart up so you can see what I'm looking at as well. So the way you look at these vols again is judging how much a market's going to move. Okay, it's no point getting into a trade and think you're going to get 60, 70 pips out of it in the next couple of hours when the vols tell you that perhaps you're not going to get an awful lot. So here are these 1 month vols. So as you can see, the euro dollar just above 5%. Cable 5.8, dollar yen coming down as well. These are the main three I look at in terms of how volatile the markets are. So you've got to adjust your trading in that circumstance. You know, last week's 40, 50 pip moves are this week's, 20, 30 pip moves. So just factor that in when you're trading. If you're trading euro dollar off the 108.30, don't be expecting 110 in the next few hours. You're not going to get it. Unless you get some headline or something. So you're going to be looking at these sort of areas, a 40 pip range. So if you get up to the top here and you're long from here, you need to be thinking about maybe taking some profit. Don't need to take it all. You can leave a little bit on, tighten your stop up so you protect the rest. And if you get the break, happy days. If you don't, you know that you need to make a decision. Do you cut even more? Do you cut out the trade and look to play the range again? Or maybe even go the other way. So apply these vols, and you can get them on the ForexAnalytix dashboard. Use it as part of your gauging how the market is living and breathing each and every day. What else have we got? Gold. It's spurred on by shorts liquidation above yesterday's highs. It's possible. It's possible, Angela. I'm always a bit skeptical about short liquidating. It's always short liquidating. It's always a short squeeze. It's never a long squeeze. It's always a short squeeze when something goes up. And I don't know why people like to always take it from that side. You never hear someone saying it's a long squeeze when the market drops. It's always someone's bearish or whatever. So I'm always a little bit reticent to believe all those squeeze headlines when we get them. What have you done in the S&P, Ali? Let's have a look. What's Ali doing in the S&P? All right, so you took a long in the S&P 52.31. Let's have a little butchers at that one. You've got quite a big. What do you got there? You got 330 odd pips risk for what? 210 pips. So again, Ali, just my own personal view, your risk reward is skewed the wrong way. And risk reward isn't something I base my trades on. I won't just trade for the sake of a risk reward, but you always want to have a more positive reward than you do risk, because that's the better way to manage it. If you lose it, if you do make a loss, you're going to make a bigger loss than if you made a win. And that's not the right way around to trade things. But anyway, S&P, I'm still long, so this is all just icing on the cake for me, whichever way it goes. And we've seemed to have found support around, call it 52.20. I said yesterday, for me, this is a bit of no man's land in here. I want to see what the price does, and it looks like it wants to show something here. Well, maybe call it 52.15.20. We had the low there, then the low stepped up, so that's a little indication that there's some support in and around this area. It is all very short-term intraday stuff, though, so I'm not going to trust it as far as I can throw it. But then I did say yesterday, this is the little zone that we need to watch up to the 50s, 52s. If we get a bounce, can it get through here and have another crack at this high? Or is it going to run out of puff into there? If it runs out of puff into there, we start to build something up at these highs, just like we tried to build stuff up here, and we tried to build stuff here, and we tried to build stuff here. Except every time we tried to build stuff, it broke and broke and broke and broke and broke. So we apply the same theme of watching the price action for this one as well. Ali, if you get a break, you need this 52.60s break, then you might be on for your 54s. But I think at the moment, this pattern is going to continue. We make a break, 50, 60, 80 pips. Then we find a bit of resistance. Then we do it again, and we find resistance. Then we do it again. If we shot from here, if we broke here and went really quickly to 54s, Ali, that to me would be a bit of an overextension. At that point, I'll be thinking, hang on here. We've gone from slow and steady to parabolic, if you like. And if I saw a situation like that, I'll be thinking more about a top then. And I'll probably be getting out the rest of my longs and maybe thinking about shorts, because that would then look like a bit of a blow-off move. But that's for then. We need to do something around these levels first. So from here, 52.15 is the level we need to watch. 52.50, and then the high up here is in the levels for the top side, and trade those accordingly. If we break below here, we need to see what happens on the test down here. But until we start knocking off some of these bigger support levels, then the trend remains. And remember, all this stuff here is all short term. This picture, as you know, I've been drawing since we had the 48 break here. Okay, we had no prior history to define these levels at, and only through just watching, seeing what the price action does, it shows you where the levels are, and then I'll start to highlight them. These are the big levels. We've got a few bits and bobs in between, but all these little lines, they're not big levels yet. These are the bigger levels. And that's how you build up your chart picture when you're trading. That's how you know whether a market is strong or weak. And it also gives you the indications of when you want to be long and when you want to start thinking about shorts. But, unfortunately, we've seen people short in every high along this. And look how many of those highs they've been taken to the cleaners on. And I don't like to see it, because people always want to sell something that's going up and going up fast. You need to let the price action tell you where to short it. It's okay having little scalps in here. When you see confirmed highs, you can have your shorts in there, but you've got to manage them. Unless you're really breaking back down, then these are just dips that the buyers are going to come in at. So scalp away, but don't be selling it up here and thinking I'm going to sit here till we get to 50 or 48 or 49 or whatever. Because if you don't get through the levels, you're not going to get there. And then you're at risk of the market turning around once more. At some point, this market's going to turn around. That could be today, that could be tomorrow, that could be 6 months' time. No one knows. The only way you'll know is by letting the price do the talking and telling you where it wants to make a high. And when you get that, and when you get the evidence of that, that's when you really make the decision to trade it. Brand cable, no real change to what I said yesterday. The wider range, even before I click on the chart, the wider range, 125, 128. You can do what you like in the middle. For me, it's cable being cable. I don't like to get involved in the middle. Let's just go into something a bit wider. There we go. Okay, I don't like to mess around in here. So I'll just sit on the edges. You know, I've been waiting for a move. I was waiting last week for a move, potentially 125.5, 125. Excuse me, never got it. Never really even came close to it. Up here, we looked like we might be on the way to breaking, but it didn't last. And then bosh, we're back in as it resistance again. So we're still range trading, going sideways on this one. In the middle here, you do what you want, mate. It's not for me. I'll still stick to sitting on the edges and deciding what I want to do from that one. Kevin, if you're shorting at the highs, you're using an intraday structure for stock placement and targets. Yeah, exactly that. You know, as I say, Gavin, it's difficult because, you know, you've done this game a lot. You can trade it intraday and you use intraday highs or intraday lows, and there's your markers for that trade any one time. It's the people who come in and go, oh, this is the top, and they want to top pick it because they want to make hundreds of ticks out of it. And it's those people who will just lean into a high and say, this is the top because I think it's the top, and the next move's going to be 300 pips lower. It doesn't work like that. And what a lot of people do is they trade their bias, not the market, not the price action. And to be blunt, that's a surefire way to do your ass. It's a surefire way to burn your account. You do not know what this market's going to do. I do not know what this market's going to do. And I've been doing this long enough. Okay, there's times when I think I know what the market's going to do, but that's often backed up with the price action. It's not just me thinking, gut feeling, this is what it's going to do. It's because I'm seeing something in the market. I'm seeing something, the way the price is going on. I mean, you know, I'm not saying this to give myself a pat on the back, but I was saying, you know, weeks before this, before the break, I'm getting the feeling that this is going to break. The price action was showing me we're not dipping. We're not coming far from this level. And you know that. You guys are here on the show. I was talking about buy stops well before this. You know, all the way back, I was going to have some buy stops getting in here because it just felt like it was going to go. And look what happens. It went and it's kept going. It's kept going. Not all trades are like that, admittedly. But, you know, all those people who are like, yeah, I'm going to keep selling it here, going to keep selling it, going to keep selling it here. And then boom. And then they want to sell the next one and the next one and the next one. So if you want a big move south, if your bias is short, if you've been hit, if you've had 5 losers up here, and let's say you've lost 20 pips each one, okay, you need 100 pips just to break even. Okay, before you even think about making profit, you've got to, your first trade is about getting the money back that you've lost shorting all these highs. If you lost money shorting up here, thinking it's going to go all the way back down. So it's a question of scale. You've had 5 losers, and now you might get 1 or 2 winners. You've got to make up all that money. You know, this is why I talk about win-lose ratios, Ali. And this is why I talk about you don't have to have 100%, 80% win ratio. I haven't got that. I've got just over 50%. But the 50, 51% that I win is always more, or most times more, than the 49% I lose, because that's how you manage it. You maximize the winners and you try and minimize the losers. So yeah, intraday, absolutely fine. You want to short here at, 42, 45, 47, because you think that's going to be a top intraday, fine. But you know that if you short here, you're going to run into trouble 20 pips lower. So there's no point shorting here an intraday trade thinking it's going to go to 51. It's not even potentially going to get through 52.20. So that's where you take some profit. You trade intraday, you nick your little pips here and there, and then that makes up for it. So you don't need to have a bias at all. But bias is very dangerous. A lot of people, I think. You don't think shit. I don't think shit because I don't know what the market's going to do. Don't know where the next pip's going to be up or down. You can make. You know what it is, Anja? It's experience. That's what it is. I'm constantly saying it. Price action is just patterns. Okay, and if you see the patterns often enough, you recognise them. You recognise what the patterns are. Yeah, top. But the dips are getting bought up. The dips are getting bought up, and then boom, you get a break. It's all about patterns, and that comes from experience. It's not I think, it's experience. I've watched these patterns a million times in 100 different assets. Doesn't matter. I could take off the title S&P. I could take off the price. I don't need any of that to know how to read price action. But that's come with 35 odd years of experience in that, and that's what you've got to learn. Every day you sit in front of your screen and watch the price move today, yesterday, whatever. That's experience. That's what you've got to take knowledge from. Because if you take knowledge from, then you know how to read stuff. You know when to short, when to long, when to make that informed guess, because you've been doing it long enough to know, and you know what the risk is in making that informed guess. Is it a high risk making that informed guess, or is it a low risk? It's like dollar yen. For all intents and purposes, a break of 152 should be 154, 155 after. That's my informed experience guess because of watching the price action. But on the other side, as I said, we've got intervention threat hanging over it. Is it a level that the officials have drawn a line at 152, hence why it's being protected so hard? So my informed guess might be one thing, the other information says another thing. And that's the difference between how you trade it and whether you trade it. So, always have a plan, and you can measure your risk by your trade size as well. If you think, this dollar yen's going to break 152 and go to 154, fine, trade it. But you need to think about how much do I really want to risk on it? Do I want to risk my usual 1%? Or do I want to just bring it down a little bit? I'd rather be right and make a little than be wrong and lose a lot. Get it right, that's fine. If you can make some money on it, that's even better. But every trade doesn't need to be hitting it out the ballpark, as they say. Excuse me. Yeah, exactly. Stick to the plan, Bran. You should tattoo that on your arm. Stick to the plan, Bran. I'll make it a saying here at ForexAnalytix. Yeah, 1.52%. Yeah, that's your strategy, Ali. That's all you should be risking intraday. Longer term trades, I can go higher than 1%. I can go, maybe even 5%, 6%, 7% if I'm trading longer term. But then I've got my risk spread out over maybe hundreds of pips. So I'm staying out of the noise. Anyway, I don't have anything much more to add to that. So maybe we'll call that a session for today. Keep an eye on what's going on with that data this afternoon. Could get markets moving around a little bit. We've got month-end stuff. So keep an eye on the clock around the tops of the hours. If you get funky little moves happening, you know that we've got some month-end stuff coming in and a few fixes going on as well. Anyway, thank you very much, boys and girls, for coming to the Flow Show. Hope you enjoyed it, and we shall see you all tomorrow. Have a good one, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.